What's up everybody, Emery here with BOA, and I want to finally make this video talking about the 3 statistical properties that you have to have in order to consider trading a cryptocurrency. And this doesn't only apply to cryptocurrencies, it applies to every financial instrument, stocks, securities, futures, options, whatever. Before I dive in, quick disclaimer as usual, this is not financial advice. I am not a licensed professional. Please talk to a financial advisor before doing anything with your money, and do not think you can hold me liable if you do something and it goes terribly wrong. For a full disclaimer, you can go to cryptoboa.io and read the one at the bottom, or you can look at any one of the emails. If you stumbled on this video and you're not a BOA subscriber, also go to cryptoboa.io, read through it, see if it's something you're interested in, and sign up for the free beta, completely free, no credit card or anything, and who knows, maybe you'll enjoy the product. Alright, now that that's out the way, let's dive into the important stuff. Let's talk about the 3 statistical properties, and they are stationarity. Let me pull up the email to have something to point at. Stationarity, randomness, and independence. So BOA, what it does is it analyzes a time series, and a time series is just a sequence of data points. So if you have, I don't know, closing prices, which is what BOA uses on every single day. It's like March 21st, March 22nd, March 23rd, March 24th, March 25th, whatever. This is a price chart. And you can look at those over the course of time, and you can basically analyze that time series, and you look for specific properties, and that's what BOA does. So BOA is going to look for stationarity, randomness, and independence. And we're going to go through each one of those one by one and talk about what they are. So stationarity first. Stationarity basically just means your time series, so your sequence of data points, has statistical properties like mean, which is just average, or variance, how much it moves up or down. Autocorrelation is how much is tomorrow correlated to today or yesterday or the day before. They stay the same. So what that means is if you had let me draw a very easy to analyze stationary time series right there. Over the course of time, let me just plug that in real quick. There we go. For the course of time, the price isn't going to change here. Every single day, the price is the same. This is 100% stationary because the mean, let's say this is 5. The mean is 5. The variance is 0. Autocorrelation is 100%. You'll always know the price. That's stationary. It's perfectly predictable every single day. But that doesn't do as much good because that's not what price looks like. So let's say you have an actual price chart. Looks like something like this, let's say. That's not stationary. So here the average, on this day, the average was like 10. And then here was like 20. And here was like 16. Here was like 30. If you drew like a moving average, it would look something like this, right? That's the average at any given point. If the moving average is changing all the time, your time series isn't stationary. So why does BOA look for stationarity? Well, the answer to that is actually pretty simple. It doesn't look for stationarity in the price itself. It looks for stationarity in the price movement. So again, stationarity is just how consistent is the behavior of this the time series. So if you have a price chart that looks something like this, we can actually measure, instead of measuring the price itself, we can measure how often and how much it goes up or down. Let's say here it keeps going up at a constant rate, so it's like 2, let's say, and then it goes to -1, and it goes to +1 and -1 and +3 and -3, and then we can draw something like that. That would be the velocity, right? The first derivative. And that may or may not be stationary. So let's take a very simplistic example. Let's say the price change every day was like up 2, down 1, up 2, down 1, up 2, down 1. This would be stationary because the average would always be up 2, down 1, be 0.5. So the average would be right here over time. And that would be stationary. Now that's perfect stationarity, and we don't necessarily need that, and none of these coins is going to have that. So BOA is going to look for basically just how consistent is the price change. How much can we trust in it? And I consider this one to be the most important statistical property for any financial instrument. If your financial instrument is not stationary, I cannot stress this enough, do not trade it. If you have a strategy that's like a moving average crossover or MACD, or you're trading the news or anything, and your time series isn't stationary, you can't trust that what you've done in the past is going to continue in the future. And just because it's stationary today, that doesn't actually mean it's going to be stationary tomorrow. That can change too. But as soon as it stops being stationary, you want to get out. You can invest in it. That's fine. If you believe in the technology, you can invest in it, but don't try to time the market if the time behavior, the time series is not stationary. That is the most important thing that BOA does. BOA isn't meant to be something where you just look at the email and say, hey, I don't know, Navcoin is a buy today, I'm just going to buy Navcoin. No, it's a confluence of factors. This is just based on some of the analysis where BOA tries to help you sort of interpret this. If it's stationary, independent, and certain patterns are true, then BOA is going to say, hey, maybe this is a buy today. But you want to use it alongside your trading strategy. So that's stationarity. It's just consistency. Consider it like stationary. It's consistency. Let's move on to the next property. The next one is randomness. And this definition of randomness isn't perfect, so I'm going to kind of use an analogy that's also going to feed into independence later. So randomness is a coin toss, right? It can be heads or tails. 50-50 chance. If I toss this coin, there's no chance, there's no way that's going to be 60-40 because it's a random event. And that's not the same as independence. Independence is going to be from one event to another. That's different. Independence means this coin toss is not impacted by this coin toss. If I toss a coin now, what are the odds it's going to be heads? 50%. Let's say I toss it and it actually is heads. What are the odds it's going to be heads tomorrow? 50% again, same thing. It doesn't change because today was heads. And that is actually something called the, I think the hot streak fallacy. In basketball, a lot of people believe this, where if a player makes 20, 30 shots in a game or something, they're like, he's on fire, he's going to keep making shots. That's not true. It's just a randomness, a blip in the statistical ether of whatever. That there is no reason to believe that an independent event would be impacted by the previous event. But let me slow down here for a second and talk about randomness first. So the thing is, randomness doesn't necessarily just mean 50-50. You could have a 6-sided die, and then you could ask yourself, what are the odds it's going to be 1, and what are the odds it's going to be 2 through 6? So the odds it's going to be 1 are going to be 1/6, and then the odds it's going to be 2 through 6 are going to be 5/6, right? So that's still random, even though the probabilities aren't equally distributed. It just means, randomness just means that if you have a certain probability distribution, you're not going to get some weird random clump where, I don't know, where 1 out of 6 shows up like 30 times in a sample of 40. That's just nuts. It doesn't happen. So if you have, for example, an average, like most of you will probably know this bell curve. This is like 50%, and then the odds of this right here happening are more like 20%, and the odds of this little sliver are like 5%. Over time, your results will sort of gravitate towards the mean. That's randomness. And BOA checks for that too. Now, randomness isn't really interesting in the BOA report because all of these coins are random. There's nothing preventing these. I mean, if you look at Ripple, for example, the chi-square is 0.13. If you saw the last video, and if you haven't, it's in the description. If you saw the last video, you'll know that this is absolutely tiny compared to this critical value of 26. And then Ether is 0.83. So these are all very random numbers. So Monero is kind of pushing it. There's some funky stuff going on, but still very much in the limits of randomness. 0.13 for Stellar, 0.6, you get the point. They're all random. So that one we usually don't worry about. The last one that BOA analyzes time series for is independence, and I just touched on that, but I'll reiterate it. Independence is today's event is not impacted by yesterday's event. That's independence. Now, we don't want that, because if our time series is independent, that means that there's nothing we can do to predict today's price from yesterday. Zero. Nothing. If it's independent, even if I tossed heads 1,000 days in a row, today's odds are 50-50. There's nothing that's impacting today's coin toss that has anything to do with yesterday's coin toss. Now, you'll be happy to hear that all of the coins in our portfolio are in fact dependent. And if you look at the chi-squared and compare them to the critical values, they're pretty nuts. There's some very strong dependencies, and that is good. That means that all the coins in the portfolio are predictable. There's things in the data that allow us to predict price. So for example, let's use a basic strategy. Let's say your strategy was trend following, and over time, this is what the coin did, right? That's dependence. You can know that today's price or yesterday's price compared to today's price, most likely today's price is going to be larger. That's a dependence. If I can know that 3 times out of 4, today's price is going to be higher than yesterday's price, that's a dependence. Now that's not anything groundbreaking, right? If I tell you, hey, Ripple's going to go up, or let's pick one I believe in. Let's say Ethereum's going to go up. hey, that I mean, sure, that I can say that you can buy into it and you never have to trade it again. You can just hold it and be happy for the rest of your life. That's fine. But we can also use this for trading. So if we know that a time series is dependent, now we're in business. Now we can start looking for strategies. Let's say you have like a MACD at the bottom of your chart or something, right? And let's say this is what your MACD looks like. Like, hey, I feel like every time that line crosses over the little histogram, price goes up. And I know that this time series is stationary, and I know that this time series is dependent. So it's been acting. It's going to likely keep acting the way it's been acting, and I can predict today's price from yesterday's price, which means something like this is actually useful. So if that's the case, you can trade this. Now BOA throws in a little perk that I think some people have misunderstood, and that's my fault for not making that clearer, where I give a little TLDR where I'm like, hey, not only is BOA going to look at stationarity and dependence and randomness, it's also going to measure the dependences and kind of give you a little hint, hey, there's a 48% chance it's going to go up and a 51% chance it's going to go down, but if it goes up, it's going to go up 6%. If it goes down, it's going to go down 4%. So those are some pretty good odds. This might be a buy today. But if the whole market is just tanking and there's blood in the streets and BOA tells you, hey, the last 30 times it looked like today, it still went up, that doesn't mean you should just act on that. You should combine this with your own strategy and your own analysis. So I actually think that's it. I think that's that covers everything. So now if you look at the BOA report, you'll know what's going on, right? You look at the price and you know, hey, it's stationary, so I can trust in the behavior, and some of them are more stationary than others. It's a spectrum, right? So 4 compared to 24 is a bit more stationary than, let's say, which one is always super funky? Verge. Verge is ironically right on the verge, and no pun intended, right on the verge, and it's kind of pushing the boundary of stationarity, so it's a pretty volatile. I wouldn't necessarily expect Verge to always act the way I want to, but I would be very confident investing in something like Ripple or Ethereum, and those are some good coins, right? So if you believe in the technology and it's relatively stationary and it's going to be dependent because they all are, or random and dependent because they all are, now you can start looking for a trading system, a trading strategy, and you can believe that you might have some success in this. So you're going to look at the report and it's going to say TLDR buy, and you can use that as another factor in your trading. So let's say your system says, hey, today's a buy. Let me check BOA. BOA says it's a buy too. Now I'm even more confident that this is a good buy. But let's say your system says Zcash is a buy. But then you see it and BOA says it's a sell. Maybe reevaluate. Just check, just to make sure that your system is right. And BOA predicts the if you look at the chart on cryptoboa.io, over 2017, BOA predicted the highest winner out of all these coins about 46 times. Now the odds of that were, because it's 13 coins in the portfolio, it was 1 in 13. So it should have been something more like 23 times. So BOA does have a track record of being a bit better than random, but you want to use other information to make your trading decisions too. In conclusion, if you're a BOA subscriber, now you know how to interpret the reports. And like I said, I am redesigning the email right now. I'm going to brush it up and try to make it look prettier. If you're not a BOA subscriber, maybe you're interested, go to cryptoboa.io, sign up, and you can get a report on the characteristics of these coins. Like I said, over all the time that I've been running BOA, randomness and dependence have pretty much been par for the course, but some coins will move in and out of stationarity. Like Verge has recently gotten a bit less stationary. It used to be around 14, now it's closer to 20. Bcash, if I'm not mistaken, is not stationary because the price data is too recent. It's only like 5-6 months. And as always, do not trade anything that's not stationary, random, and dependent. Hope this was helpful, guys. If you want to see some more videos like this when they come out, feel free to subscribe. I'm not really looking for subscribers or anything, just making these videos and sending them out to the subscribers. It's more important that you go check out BOA and use it if it helps you. And good luck trading.